Nikkei 225 has just punched through 71,000 like it was nothing. Up 1.65%, over 1,100 points in a single session. The monthly chart screams strong buy. The weekly is strong buy. The daily, the 4-hour, the 1-hour, everything is aligned. And yet, while the index was melting up, Bridgestone, one of the heavyweights, was sliding. Not a gentle dip, a genuine, attention-grabbing slide. That right there is your first warning that this rally is not as clean as the headlines make it look. There is one danger zone and one hidden opportunity right now, and I'll show you both. Stay to the end. I am giving you 3 exact levels you can trade today, complete with entries, stops, and risk-reward ratios you can screenshot right off the screen. Write this number down. 70,018. That's the daily pivot. But more importantly, write down 69,423. That is the S1 support level and the line in the sand for this entire melt-up structure. Right now the session bias is undeniably trending higher. The trend is your friend until it ends, but I am going to tell you exactly where it could end and where the trapdoor opens. The herd is positioned heavily long after the 71,000 breach. Client sentiment shifted the moment we crossed that psychological barrier. The retail crowd piled in, believing the breakout is confirmed. And that's exactly what the big money wants you to believe. When everyone is on one side of the boat tips. If the Nikkei loses 69,423 today, the entire structure resets. The melt-up becomes a liquidity grab. The bullish narrative fails, and we are staring at a 1,600-point flush toward the 68,000 handle. You need to have that invalidation level burned into your trading plan. So, pause this if you need to, write it down. 69,423. Losing that level opens the trapdoor. Now, let's walk through the technical landscape from the very top down, because the higher timeframes are telling us something that the 1-hour excitement completely hides. Start on the weekly chart. The 200-week moving average is not even close. It's sitting down near 55,577. The fact that the Nikkei is trading at 71,000, miles above its 200-week, tells you this is a structurally powerful bull market. The 50-week moving average at 63,748 hasn't even been tested in months. What does that mean? It means on any meaningful pullback, there is a massive vacuum zone of air beneath us. This market is stretched like a rubber band. The daily chart tells the same story. The 20-day moving average is at 66,807, the 10-day at 68,375, and the 5-day at 69,482. Notice the gap between the 5-day and the 20-day. The short-term averages are accelerating away from the medium-term anchor. That's a classic blow-off characteristic. It doesn't mean the move is over today, but it means the snapback, when it comes, will be fast and violent. Drop down to the 4-hour chart. Here's what most traders miss. The MACD line is still positive. Absolutely. The histogram is deep in the green, but look closely at the slope. It's rolling over. The histogram has stopped making higher highs while price has continued to push higher. That is a textbook hidden negative divergence. Momentum is bleeding internally even though price hasn't shown it yet. The RSI on the 4-hour is sitting at 71. That's not extreme, but it's overbought, and the stochastic oscillator is screaming at 96.2. This oscillator hasn't been this stretched in weeks. The Williams percent range is at negative 0.55, basically pinned at the top of its range. Every mean reversion trader on the planet is watching these levels, and they are waiting for the first 1-hour candle to close below the 5-hour moving average to pull the trigger on shorts. That trigger zone rests near 69,482, which happens to align almost perfectly with S1 at 69,423. This is the cluster you cannot ignore now. The support and resistance levels are beautifully clean today. The pivot sits at 70,018. Right now, price is trading above the pivot, so the intraday sentiment is bullish. But we are sandwiched between a 1 at 70,613 and a 2 at 70,981. In fact, We already blew through a 1 and are now challenging a 2 as we speak. The true breakout level, the one that could ignite another 250 points of melt-up, is a 3 at 71,576. If we get a 4-hour candle close above 71,576, the trend acceleration is confirmed and the Nikkei could stretch towards 72,500 very quickly. But if we fail at a 2, if we see rejection candles with long upper wicks around 71,000, that's the first signal that the exhaustion is real. The support structure below is S1 69,423, S2 69,056, and S3 68,481. Notice how S2 and S3 sit just below the 5-day moving average cluster. That means a break of S1 would slice through the short-term trend like a hot knife through butter. No soft landings, just a sudden vacuum down to 68,000. Now let's connect the macro and the cross-asset linkages, because that's where the true narrative builds. The 24-hour core news is focused on Bridgestone stock sliding. On a surface level, one stock shouldn't matter that much for an index weighted with exporters and tech names. But dig deeper. Bridgestone is a cyclical, global industrial. Its slide hints at raw material cost pressures or a demand warning in the auto supply chain. Exactly the kind of signal that could foreshadow a broader growth scare. Yet the Nikkei ignored it and ripped higher. Why? Because the yen is weakening again. The dollar-yen pair has been edging back up, and when the yen weakens, Japanese equities, especially the heavy exporter constituents, melt up almost tick for tick. This cross-asset linkage is the ghost in the machine. As long as the yen keeps sliding, the Nikkei can defy gravity. But here's the trap. The Ministry of Finance's intervention shadow is back. Every tick lower in the yen increases the probability of a verbal or actual intervention. If dollar-yen spikes suddenly and Japanese officials step in, the Nikkei will reverse violently. That is the hidden risk that most pure equity traders are not pricing in. Over the next 1 to 2 weeks, my directional lean is cautiously bullish while we hold above 69,423. But the moment dollar-yen shows a sharp reversal, or the Nikkei closes below that S1 level, the lean flips aggressively bearish. I want you to comment right now. Do you think the Nikkei breaks 72,000 this month? Type yes or no in the comments. I'm tracking consensus, and the contrarian signal is often found in those numbers. Most people skip the trade setup section. That's exactly where the money is made. Keep watching. I am going to give you 3 strategies, each with exact entries, stops, and targets that you can literally screenshot off the screen. The on-screen graphics will show you every number. Strategy 1, the sniper. This is the conservative long plan, designed for traders who wait for confirmation and refuse to chase. The core idea is to buy a healthy pullback into the S1 demand zone rather than buying the euphoric breakout. Here's the exact trigger. You wait for a 1-hour candle to close back above 69,500 after a dip into the S1 region near 69,423. The confirmation signal is that close accompanied by a bullish engulfing or a pin bar rejection wick. Your stop loss sits at 68,950, just below S2 and the cluster of short-term moving averages. The logic is simple. If the market breaks below that level, the pullback is not a dip buying opportunity, it's the start of the flush. Take profit 1 is 70,613. The former are one that will act as a magnet. That gives you a clean 1 to 3.2 risk-reward ratio on just the first target alone. Take profit 2 is the R3 zone at 71,576. That stretch would deliver roughly a 1 to 5.4 reward profile. The entire setup is voided if we get a daily close below 69,000. If that happens, the sniper stays in cash and waits for a new structure. Now, here is the on-screen trade card for the sniper. Editor, overlay this exactly. The sniper, conservative, entry, 69,500, 1H close above after dip into 69,423, stop loss, 68,950 take profit 1, 70,613 take profit 2, 71,576 risk, reward, 1:3.2R to TP1. 1:5.4R to TP2 invalidation. Void if daily close below 69,000. Strategy 2. The active trader. This is the standard trend continuation play for those who believe the momentum has more fuel but still want a structured entry. Do not simply market buy at 71,000. That's what the herd does. Instead, wait for a confirmed breakout of a 3 and then trade the retest. The entry condition is a 1-hour close above 71,600. That's just above a 3 to ensure the breakout is real, and then a subsequent 1-hour close back inside that level, confirming support has flipped. You're buying the retest of the breakout point. Your stop loss goes at 70,900, just under the R2 pivot and the psychological 71,000 mark. The risk is about 700 points, but if the momentum is genuine, the Nikkei should never look back below 71,000. Take profit 1 is the psychological level of 72,500. Take profit 2 is 73,000, a level that maps to a 161.8 Fibonacci extension of the last swing. Once target 1 is hit, immediately move your stop to break-even and trail it by half the ATR, which is roughly 1,000 points, to lock in gains if the rally extends. This active trader setup is invalidated if the price falls back below 70,018 on a closing basis, the pivot. Now, let's get interactive again. Type your Nikkei range for tomorrow's session in the comments right now. Give me a high and a low. Let's see who is aligned with the key levels. I'll shout out the most accurate call in tomorrow's video. And here's the on-screen trade card for the active strategy, the active trader, standard, entry. 71,600, 1H close after breakout and retest, stop loss, 70,900 take profit 1, 72,500 take profit 2, 73,000 trailing stop rule, move stop to break even after TP1, trail by 1,000 points invalidation, void if 1H close below 70,018. Strategy 3, the aggressor. This is the high-risk fade play, counter trend, designed only for those who can manage small size and accept being wrong quickly. The thesis is that the extreme overbought oscillators will trigger a sharp intraday mean reversion from the R3 exhaustion zone. The entry is a sell limit order at 71,576, exactly at a 3, with a tick requirement. You want to see a 15-minute bearish engulfing candle or a long upper wick rejection before the order triggers. Your stop loss is at 72,100. Above the round number and any liquidity hunts. That's a risk of 524 points. Take profit 1 is the daily pivot at 70,018. That's where the first wave of dip buyers will step in, and you want to take partial profits aggressively. Take profit 2 is 69,423, the S1 level that we have identified as the linchpin of the trend. This setup offers a staggering risk-reward profile, over 1 to 3 on the first target and up to 1 to 5 on the second, but it goes against a powerful trend, so the failure rate is high. Only enter with capital you are prepared to lose completely. The invalidation signal is any 4-hour candle close above 72,200. If that happens, the aggressive short thesis is dead and the melt-up is probably going to 73,000 without you. Here is your on-screen card, aggressor, the aggressor, high risk, entry. Sell limit 71,576, require 15M bearish rejection, stop loss, 72,100 take profit 1, 70,018 take profit 2, 69,423 risk, reward, (1:3.0R to TP1, (1:5.1R to TP2 invalidation, void if 4H close above 72,200 warning, counter trend, high failure rate. Risk small, risk management pulse, 30 seconds straight. Never risk more than 1 to 2% of your account per trade. Do not hold positions through high-impact Japanese economic releases or Bank of Japan speakers. Stops are non-negotiable. This is how you survive to trade the next big move. The Nikkei can move 2,000 points in a heartbeat, and the leverage in index CFDs and futures will destroy an account without discipline. Manage your risk first. The profits will follow. Now, as we close this loop, let me give you the single most critical level for the next session. It is 69,423. That is the level that holds the entire bullish structure together. If we open tomorrow and the Nikkei holds above it, the melt-up remains alive and the active trader setup comes into focus. If we lose it, the aggressive short becomes the master play, and we are likely heading for 68,000. Tomorrow's wildcard is the Bank of Japan Summary of Opinions, plus any fresh yen intervention headlines out of the Ministry of Finance. We will be tracking dollar-yen tick for tick, because the Nikkei is the global risk barometer that cannot divorce itself from the yen's path. If you want the full breakdown on Bitcoin and the S&P divergence that is developing right now, that video is live on the channel. Tap the end screen and watch how the liquidity tide in US equities is going to collide with the Nikkei's blow-off. Smash the like button if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one, before the next explosive move hits.